Welcome back to The Explainer, everyone. Today, we are unpacking a seriously fascinating earnings report from Enterprise Products Partners for the second quarter of 2026. What we've got here is this incredible intersection of acute global demand colliding with just absolutely record-shattering financial volumes. If you've been tracking the energy markets at all, you know that macro-environmental forces are totally reshaping how resources move around the planet right now. Today, we're going to see exactly how those massive global shifts translate directly into physical infrastructure and bottom-line numbers. It's a wildly compelling story of supply, demand, and sheer scale.
Okay, let's dive into this roadmap. First, we'll look at a record-breaking quarter, then geopolitics driving global demand. Third is our segment breakdown on the volume boom, followed by investing in future growth, and finally, returning value to investors.
All right, let's kick things off with Section 1, a record-breaking quarter. Prepare yourselves, because these numbers are huge.
Right out of the gate, let's hit the bottom line up front. Enterprise reported a record $1.8 billion in net income attributable to common unit holders for the second quarter. Just to put that into perspective, that is a massive 28% jump compared to the exact same time last year. Seeing that level of quarter-over-quarter growth in such a mature, capital-intensive industry, it's staggering. It immediately tells us that something truly unprecedented is playing out in the broader market. And honestly, it gets even better. When we look at their adjusted EBITDA, it came in at a record $2.8 billion. That's a really healthy 17% increase. For those of us focused on the core profitability of a company's operations, adjusted EBITDA is great because it strips away all the noise of financing and historical cost basis. It shows us the raw, unfiltered earnings power of the company's assets. And right now, those assets are churning out cash at an unprecedented clip. But you know, financial numbers don't just magically appear out of thin air, right? They have to be anchored to physical reality. This number, 14.7 million, represents their record equivalent pipeline volumes in barrels per day. That's an 8% increase year over year. I mean, think about the sheer logistics required to physically move nearly 15 million barrels of natural gas liquids, crude oil, petrochemicals, and refined products through a pipeline network every single day. The financial success we just talked about, it is entirely downstream of this physical operational reality. Which brings us nicely to Section 2. Geopolitics driving global demand. Let's look at the why behind the numbers. Now, what's really interesting about this slide is how co-CEO Jim Teague humanizes all that raw data. He points out that these record pipeline and marine terminal volumes were driven directly by strong international demand for U.S. energy, which specifically peaked in April and May. So this wasn't just some gradual, slow-burn uptick in domestic consumption. Not at all. It was an acute, sudden pull from the international market desperately needing U.S. exports to fill a void.
So what exactly caused that void? Well, during this period, global shipping faced severe disruptions due to hostilities in the Middle East. This led to damaged regional production facilities, intense navigation restrictions, and ultimately forced commercial shipping lines into much longer transit times because of extensive reroutes. When traditional global energy supply chains face that level of sudden, intense uncertainty, the international market urgently scrambles for stability. And in this particular quarter, they found that stability in U.S. energy infrastructure. That's what drove this massive surge in demand. Moving on to Section 3, segment breakdown, volume boom. Let's see how the infrastructure actually handled this.
Now that we understand the global catalyst, let's dig into the operational effects. The absolute clearest evidence of this international demand pull shows up in marine terminal volumes. This is the actual energy being pumped onto ships for export. Look at this massive 33% spike. It jumped from 2.1 million barrels per day in Q2 of 2025 to a record 2.8 million barrels per day in Q2 of 2026. When the world needed to urgently backfill its energy supplies, that pressure immediately hit the export terminals. Enterprise's facilities were uniquely positioned to not just absorb that bottleneck, but to monetize it. And this brilliantly illustrates the reality on the ground. Processing and exporting those millions of barrels requires massive physical infrastructure. We're talking about their sprawling Montville View fractionation complex and the newly expanded Neches River Terminal, which literally just had its second phase placed into service in May. Handling this kind of capacity demands thousands of miles of pipe, vast storage complexes, and enormous dock facilities, all working together in perfect synchronization to meet that international shipping demand. Plus, if we look domestically at where the supply pressure is localized, there is a fascinating contrast. While overall natural gas processing inlet volumes across their entire network grew by a steady, respectable 4%, inlet volumes specifically from the Permian Basin just exploded by 14%, hitting 4.3 billion cubic feet per day. This tells us loud and clear that the Permian Basin remains the hyperactive engine of U.S. production growth. Midstream operators are having to constantly upgrade their networks in that specific region just to keep pace with the drillers.
All right, let's pivot to the future with Section 4. Investing in future growth. So, with geopolitical tension staying high and Permian production booming, how is the company planning to capitalize on this long term? Well, they've announced a massive capital expansion roadmap. First, they're adding a new 150,000 barrel per day NGL fractionator, dubbed Frac 15, at Mont Belvieu. And to process all that surging Permian gas we just discussed, they're building two giant 300 million cubic feet per day gas processing plants, Plant 13 in the Delaware Basin and Plant 11 in the Midland Basin. Add it all up, and they currently have a staggering $6.5 billion in organic growth projects under construction. They are aggressively building out their physical footprint so they don't leave any of this international demand on the table.
Let's move to and see how this builds out over time. These massive capacity expansions are sequenced over several years. By Q4 of 2025, they expect their LPG export marine terminal expansion to be totally finished. Then, looking a bit further down the road, Plant 13 in the Delaware Basin should begin service in Q3 of 2028, and Plant 11 follows closely in Q1 of 2029. This gives them a multi-year runway of calculated, steady capacity additions designed specifically to match long-term forecasts of global reliance on U.S. energy.
Finally, let's wrap things up with Section 5, returning value to investors. All this macro-driven volume and multi-billion-dollar capital expenditure is super fascinating, but what does it actually mean for retail investors and shareholders? To figure that out, we look at distributable cash flow, or DCF. In plain English, after the company pays for its day-to-day operations and the routine maintenance required to keep those pipelines running safely, this is the cash left over. For this quarter, operational DCF was a record $2.3 billion. And with that cash, they struck a very deliberate balance. They distributed $1.2 billion straight to unit holders and retained $1.1 billion. That translates to a very healthy 1.9x coverage ratio. By retaining almost half their cash flow, they are internally funding those massive billion-dollar growth projects we just looked at, instead of having to take on expensive debt in a high-interest rate environment. It's incredibly smart capital allocation.
So the crucial point is this 56% payout ratio for the trailing 12 months. This tracks distributions as a percentage of adjusted cash flow from operations. Now, this figure is highly attractive if you follow market mechanics, because it encompasses both their steady, declared cash distributions and their aggressive share buybacks. They've actually already utilized 34% of a $5 billion buyback program. What this proves is that a company can simultaneously fund aggressive, multi-billion-dollar physical expansions while still returning over half of its operating cash flow directly back to its investors.
So as geopolitical tensions continue to redefine global shipping routes and disrupt those traditional supply chains, how will this increasing global reliance on U.S. energy infrastructure shape the market's future? We've seen today how a disruption halfway across the world literally immediately results in record volumes and billions of dollars flowing through Texas pipelines and export terminals. The macro forces are in motion, the infrastructure is expanding, and it is going to be incredibly compelling to watch how this all plays out over the next few quarters. Thanks so much for joining me for this explainer, and as always, keep learning.